Hi there, I'm Tyler Bollhorn. Welcome to the Stockscores market analysis for August 17th, 2010. I'm on the Trading Desk website, which is a sub-website to Stockscores.com. It is a new website that will eventually be integrated into the existing Stockscores.com site. You can see the address at the top, tradingdesk.stockscores.com. The things that I'm going to show you today are free to use. You simply have to set up an account, and then you can use some of these chart watching tools and such for free. Now, as I always do, I'm going to analyze some charts. We're going to start off with the chart of the Dow 30. It's been a bit of a confusing market over the past few weeks because we've had conflicting signals on different time frames. Now, I like to use trend lines to pick my or make my determination of who is in control of the market, whether it is the buyers or the sellers. And you can see that we had a break of a downward trend line in mid-July, and then we had a break of a upward trend line just a few days ago, and these are conflicting signals. On the medium term, we've got a bullish signal, and on the shorter term, we have a bearish signal. Now, what often happens after a break of a trend line is the market will make a comeback as a sort of sucker rally and then reverse direction. So, if you think about the trend line that was in place leading into July, we had a break of the trend line there. We fell lower and then ultimately went higher. More recently, we had a break of the upward trend line that was just a few days ago, and now we are rallying higher. What is likely happening is we're going to rally up into here or so, and then reverse and move lower. I would say that is what will probably happen, and when I say probably, I mean something better than 50%. My estimate is that it is about a 60% chance that that is what will happen. There's a 40% chance that this little pullback that we've seen more recently is just a pullback in this cycle of rising bottoms, and we are ultimately headed up towards resistance over here. I'm going to call that a 40% probability. So as you can see, it's a very difficult time to try and gauge the market. Now, if you look at seasonality, the markets are normally weakest in September, at least historically. We've had a pretty decent rally through July. And so I think it is quite reasonable that we may have a few days of strength here, but ultimately that September factor combined with the picture we're getting from the charts is likely to lead this market lower through September. So I suggest some caution with stocks, recognizing, however, that my cautious outlook is far from certain, as I do think that there is a 40% chance that this market could move higher. Let's take a look at the Canadian dollar. The Canadian dollar is a good benchmark for what commodities are doing because the Canadian market is so heavily weighted in commodities. And you can see here that we've got a cycle of rising bottoms. That is a sign of optimism. We had a break through that cycle of falling tops recently. It pretty much failed because we pulled back. But over the last few days, we've had a bit of a rally in the Canadian dollar, and I think that probably continues. Probably takes us up to about 98 cents on the Canadian dollar relative to the US, which is pretty decent. I would say that the Canadian dollar is telling us that commodity prices are improving, but that the upside is fairly limited. Let's go on to the next chart in the bunch here. This is the chart of gold. And of course, gold is a sort of uncertainty type trade. When people are uncertain about what's happening in the market, they tend to buy gold. We've seen a rally in gold over the last couple of weeks. But I think that the upside is limited. I am bullish of gold, but with the upside set to where I've drawn that horizontal line, I think that the upside really isn't worth the risk. You know, in other words, you've got this much reward for the distance down to support, which is that much, so the risk outweighs the reward, and for me, that's not a trade worth taking. So if you're long gold, I'd stay long gold, but I certainly wouldn't initiate positions here. The US dollar has fallen recently largely because of some strength in the, oil has fallen recently largely because of strength in the Canadian or in the US dollar. You can see here that the oil prices have fallen back. They are at support now, and so we should get a bounce back in oil, and it started a little bit today. I think that oil probably bounces back over the next few days, but upside relatively limited for oil. NASDAQ 100 is going to look pretty similar to the chart of the Dow, and in fact it does. We've got that cycle of rising bottoms, and we've had some strength today, but I can't ignore the fact that that little upward trend line that held up for about 5 weeks was broken last week, and I worry that this little bit of strength that came today on the on the earnings from Walmart as a good impetus for that rally. I think this might be a bull trap, and I'm going to be pretty cautious buying stocks into this rally. Moving along, chart of the S&P 500, same sort of situation. We've got a little bit of a rally today, but considering where resistance is, I just don't see the risk-reward ratio being great. If you think about that's your risk and your potential reward is up to here, you're looking at about 1 to 1. In other words, the amount of reward up to resistance is about the same as the amount of risk down to support, and I prefer trades where I've got a 2 to 1 risk-reward ratio. Let's take a look at the Canadian Stock Exchange, which is this chart right here. Canadian market's been locked in a trading range, pretty boring, but when you consider what the U.S. markets have been doing over the last year, the Canadian market has been a pretty safe haven, and it continues to look decent. Canadian market is ultimately going to move with commodity prices. If the Canadian market can really start to make breakouts, that would imply that commodity prices are moving higher, which means a global recovery is underway. As it is right now, we're pretty neutral on that, which I would say means a global recovery is also neutral. Final chart is of the US dollar. It had a pretty sharp fall for a few months. There you can see that. It came down to support where it should bounce. It did bounce, and I expect now it will simply wind its way sideways in there for a little while. That's probably a good thing if you want to be a buyer of U.S. stocks, because of course the higher the U.S. dollar goes, the more expensive those U.S. stocks and commodities are for investors. And so hopefully the U.S. dollar just goes sideways here for a little while. Well, that has been a quick overview of the different things that I look at, mostly considering them through the concept of a trend line. Trend lines are very important. Keep an eye on those. When trend lines are broken, you often get reversals. That has been the Stockscores market analysis for August 17th, 2010. Have a great week in the market and trade well.